So we're in here like fumbling around with stuff a little bit.
I know folks need to go on the Facebook as soon as you go up live. I know you're not there yet, but it is a very pretty studio with one pretty chair, and I wonder who's going to get that one lone chair today.
Well, nobody today because we're all standing, but
okay, all right.
Picking up 5 more, so it should be really, really exciting.
You know, this show's an hour long. You're going to be standing the entire time?
Well, you know, when we're in the Beasley studio, Pat, we're usually standing there the whole time. You know that. So don't.
Oh, really? Oh, really?
Yes, we're not standing usually when we're in the Beasley studio with you?
Sometimes. Oh. Yeah, I got a caller that called in, and they wanted to know that, you promoted that you were going to have talk all about insurance for your home today. They wanted to know when you were going to talk about resurfacing bathtubs again.
Oh, gosh, that's been a while. I didn't, that guess was a little different.
They wanted to know because I guess they're going to do a remodel in their bathroom, and they wanted to find out how to resurface their bathtub.
I'll tell you what, for the person listening, go ahead and call us at our off-air number 813-377-2775. We'll hook you up with the guy that does the resurfacing. They also resurface countertops, by the way.
I knew you could do it.
Amazing stuff. Yeah. So 813-377-2775 will get you hooked up with that particular person that you're looking for, or any of our other people that we've had. If you want to get connected, let me know because we have all their information. And so without further ado, let's see if it's working. We're going to run over to Adam Talley. Good morning.
Hey, good morning.
Are we potted up? Not yet. So we got to get you fixed up here. We're still we've been messing with all the equipment here, Pat.
Well, you had to because you kind of remodeled everything.
We did, yes. So we got a new studio table in here, and we're going to be basically bringing in some chairs and, trying to open up that diaphragm a little bit so we're a lot taller than we were before. How about now, Adam?
How am I doing?
Right.
How am I doing, Pat?
You're hot.
Yeah, you're sounding good.
Oh, that's great. It's good to hear you, Pat.
And guess who else is back with us this week?
Would that be Leo Cannyn from Beryl Engineering Inspection?
How was Australia?
It was phenomenal. I saw penguins come out of the water. I saw penguins walk. Hundreds of penguins just come out of the waters, just start walking back to their little loved ones, and then vomited fish into their mouth. That's what
if you went to Australia just to see penguins, you could have just went right to the Florida Aquarium.
The aquarium in the Busch Gardens penguins are a little different. They're in a little box. They're in a habitat. This was to see wild penguins. It looked like the beach of Normandy, like from Saving Private Ryan, but with penguins. They came out of the water. They stopped. They looked around for eagles. They looked around. They waddled a little bit. They ducked, and then they made a mad dash, and then we were in a straight line. It was called the Penguin Parade of Phillips Island. It was phenomenal.
Let me be the first one to say then. Good day, mate.
Hey.
You didn't pick up any of the accent.
No, I didn't. But I did.
Thank goodness.
Did pick up some kangaroo. Literally picked it up and then ate kangaroo. Not the same one.
Did you really?
Yeah.
No way.
You get to pick your kangaroo, and then they'll make it into a burger for you. Is that how it works?
Funny.
Like a lobster at
Lobster. Here's something a little funny, though, about Australia and the kangaroos. Is there are 3 kangaroos for every person in Australia. And because it's like on their flag or in their crest, they don't really eat it. Everyone who eats it says it's delicious, but they don't really eat it. It's a sustainable food source for them, but they don't go for it.
Interesting.
They'd rather just have sheep and cow and all that other stuff.
Very interesting.
Yeah.
Well, All right. So without further ado, let's run to our topic for the day. So last week, we were talking a lot about this. You missed all the fun last week, Leo, but we were talking all about an insurance policy. And Adam and I had the chance to chat about this even yesterday. And so we know, listen, the fact of the matter is we already know that you guys, including myself, right? So I'm throwing myself right under the bus with you. We know you're not actually reading that, how many page policy, insurance policy?
Your deck page is probably about 5 pages. The policy packet's somewhere closer to 60.
Yeah, and so nobody ever reads that stuff, and that's what you're here for. You've read it, Leo?
I have to read it because I'm constantly on the side of the plaintiff against the insurance company for them denying coverage. So I have to find all the contradictions in the report.
Of course, yes.
I'd love to ask Adam about all these contradictions. The ones where they say
talk about it today.
They don't cover this, but then later 4 clauses in the same paragraph section they say they do cover it. All this inconsistencies where I have my fun.
So what I've asked Adam to do is actually, not only are we going to dive into the homeowners insurance policies today, but we're going to talk about some stories along the way and why it might matter to have different coverage over another. Maybe even talk a little bit about the traditional type of coverage, right, that a lot of people have.
Absolutely.
So where would you like to start on this policy? Dwelling, I imagine, right at the top?
Yeah, let's start at the dwelling coverage because that kind of, we talked about the appraisal last week, and a lot of people get confused sometimes if they're buying a house, and let's say they're buying a house in South Tampa, for instance, and they're buying a 1,200 square foot bungalow, and they're buying it for $800,000, and they want to know why we're not insuring it for $800,000. And
excellent.
The key reason there is that we don't insure land. So
well, why would you need to, really?
Exactly. So, but they don't understand. They think, oh, it's worth $800,000, and that's how much I'd want to get back, and if something happens. So the way we determine dwelling coverage is we run what's called a replacement cost estimator. So every carrier has their own replacement cost estimator. There's two main ones out there. There's 360, and then there's Marshall, Swift & Beck, or MSB. And what it is we're putting in all the information of your home. So square footage, construction materials, flooring, everything, okay? And then it tells us how much it would be to rebuild your house brick by brick.
And I imagine you guys pull that information from public records, right? Is that where they get it from?
Yes. So I go on to a couple different resources. I'm going to do the property appraiser's website so I can get accurate, dimensions. Zillow is very helpful because usually if it's for a new home purchase, there's photos of the inside and everything else like that. So it's a lot easier to go in and say, okay, it has wood floors. Let's make sure we account for that.
What about when you guys get the appraisal? Does that change much?
We don't really get the appraisal.
But if you did, because I know back in the day they used to, maybe before the software was out, they would get that and they would have like a breakdown on what the appraiser thought the value of the land was, and they had a cost, basically a couple different ways they appraise it. I imagine you guys will talk about that next week with Danielle.
Maybe. So the appraisal doesn't really come into play for what we do because, like I said, every carrier is going to want you to base everything off of the replacement cost estimator that they use.
I don't know a ton about these homeowners insurance policies. I've definitely never read all 60 pages. I have a mortgage and like a real estate contract and that kind of stuff, but not this. So with that being said, when you just say, hey, I want replacement costs, which I know I always have that on everything that I insure. But that's not only for the home, but that's the inside of the house? Is that the same?
In property insurance, there's two ways to cover things. So you have replacement cost and you have actual cash value. I always like to use the example, let's say, you have a flat screen TV that you bought in 2010, right? And lightning strikes and everything blows up. If you had actual cash value, which is the depreciated value, they're probably going to give you like $20 for that TV because that's what a 9-year-old TV goes for on eBay. If you have replacement cost, they'll probably give you $800, $1,000 for that TV because that's what it costs at Target or Best Buy or wherever you like to buy your electronics. So that's the difference there. When it comes to the dwelling coverage, it's 100% replacement cost. If it is actual cash value, it's usually not a homeowner's policy. It might be a builder's risk or a short-term policy. Something like that when an investor buys a property and they're just trying to do a quick flip and it's a 3-month.
Would be otherwise not insurable, right?
Pretty much, yeah. They're not asking the questions on the the age of the roof and that kind of stuff. They're just insuring it and going from there.
Your replacement cost estimator, in a nutshell, allows me to basically get my home rebuilt in the event, let's say, lightning struck it and the whole thing burned down,
Correct.
Right? So what about if you've been in your home for a long time, right? And, does this change automatically over time? Does it matter? Like, what if your coverage is lower, but you bought your house 20 years ago, and now the cost to build is obviously more than it was 20 years ago? What about that scenario?
Well, that's a great question. And there's a couple parts to that. So when it comes to your dwelling coverage, you'll notice that pretty much every single year, your carrier is increasing that from year to year, usually 3%, something like that. And what that is to account for the increase, due to hi everybody.
I'm sorry, I'm moving you around.
Yeah, I
couldn't see Leo, so.
But that's
talking
due to inflation and everything else like that. So they do that. But sometimes it's good to review your replacement cost estimator so to make sure it didn't go too high. In case they've done it 3% every single year.
So long story short, they're going to basically build in and factor that increase. Is there ever a time that it's too low, that their estimate was lower than what it would cost to rebuild?
There is, and maybe when we come out of the break, we can talk about two coverages. One would be ordinance or law, and one would be increased replacement cost on your dwelling.
Sounds like a plan, and I'm sure Leo's going to have some questions to tag right into that.
Lots of questions.
All right,
Lots
so
of
will you
questions.
just jump in when they come to your mind? You're listening to Tampa Home Talk. I'm your host, Katrina Madewell, here with Leo Cannyn and Adam Talley with Talley Insurance, both official show partners of Tampa Home Talk. Our off-air number is 813-377-2775, 813-377-2775. You almost heard whatever question Leo was trying to ask me during the break. We're glad you're here.
No, I was just asking if you had an outbound mailbox here.
Yes, we do.
Awesome.
Nothing exciting. Nothing exciting. All right, so welcome back. We're talking with Adam Talley today all about your homeowner's insurance policy. As we promised we would last week and a couple weeks prior, we're going to pretty much tear it up and go through it and dissect it. And also, when we're going through this, Adam, maybe talk about some stuff that you see, especially like if you get a new person that comes to you and you're reviewing a policy they have with someone else. You know, what are some of the things you look for in this that you're surprised by that you talk about and they normally change? Because you're probably a little more thorough, I would say, than a lot of insurance agents.
I try to be. You know, my background when I first started in the industry, I worked for a carrier, so I know kind of how the underwriters are looking at things. That's why I know to go to the property appraiser and everything else, because I know they're going to tear it apart, you know, depending on how thorough they are. So, you know, one of the things that I see is a lot of people, they want to go for the least expensive option. So when we start going into their policy and I kind of point out, well, you know, I ran the replacement cost estimate, like we're talking about, it looks like we need to be a little bit higher. Replacement cost on contents coverage, things like that, where especially in some of these newer homes where it's a brand new home, you're talking a difference of maybe $100 to have a fully loaded policy versus a
it's
stripped
easy
down
breezy.
policy.
You know what's in there. It's up to building codes, right?
Exactly. So it's that's one thing, and then you know, on the flip side of that, sometimes you see policies where there's way more stuff on there than the people really need. They went with whatever the person said and never really looked at it. And
So what's the case most of the time? Like, are they underinsured on like other structures? Are they?
I would say underinsured is probably more common than overinsured.
Okay.
You know, sometimes you'll see somebody that has ordinance or law coverage on a brand new home, and we know they don't need that because the laws haven't changed in the 12 months since they built that house. So things like that, you know, kind of factor in.
Right. So dwelling's obviously your house, right? Mm-hmm. But when you get into other structures, like on this particular policy we're looking at, it's got a $400,000 limit for dwelling. Mm-hmm. Other structures is $8,000. What is that? What's included in that $8,000?
So
what's that covering?
Other structures, and certain carriers are different. Some carriers include the pool. I would say I have two of them that include the pool, and other structures, all the rest included in the dwelling coverage. And so other structures is going to be everything that's on your property. It's not part of your house, right?
So, for example, it could be what, a shed?
Like fences, sheds, bird baths.
What if your car burns down? Is that homeowners?
That
or
would be
that
your car insurance.
It would, okay.
Yeah, as long as you have comp and
Just
collision.
curious if it was on your property, like in your garage or in front of your garage.
That'd still be your auto insurance.
Not necessarily.
Well, I was thinking about that. Like, what if you just have a junker car or like something like my Prius, for example? I don't have full coverage on that. I don't need it. Like,
yeah.
It's, you know, if it gets wrecked, I'm just going to buy another one. I don't need to fully insure that. It doesn't make sense for the cost difference. But what if it were in my garage and my house burned down? Shouldn't that be covered by homeowners?
I would say it depends on how it happens and what happens to it. You know, more often than not, I'd like to see the scenario where it happens, and you know, hopefully you're fully covered on both, and that'd be the way to.
So what are you seeing in other structures, Leo? A shed? What else?
A shed, detached garages, swimming pools, things of that nature. Fancy fence would be other structures.
Yeah. Fancy fence.
Fancy
so
fence.
The vinyl fence.
The vinyl
doesn't
fencing,
count.
the automatic gate enclosure fences. We're seeing a lot of that for other structures.
Okay. So if you've got a huge property maybe and you've got a horse gate around it, that could include other structures as well.
I like the long pause for the horse. Like, horse, not covered. Gate, okay.
Well, so if you have a horse or any sort of livestock, something like that, most carriers are going to shy away from that. We do have
so
some.
They don't want to insure it if you have one.
No, they don't want to insure your home if you have a farm on it. But we do have some carriers that will do a farm, as long as it's not, you know, huge.
Well, I
They'll
wish
have
Darren was here.
They'll have like a
Ask him
mini
who-
farm coverage.
who he had his insurance with. I want to talk about animal liability too, because we talked a lot about that yesterday.
Yes, ma'am.
All right, so personal property, this particular policy again, how much was this house? Like, what did it sell for? Do you know?
I believe it was somewhere in the 550s,
Okay.
560s.
So it
It's in
sold
a
for
gated community.
Okay, so it sold for $550. Was it a newer house, older house? What are we
This
looking
house,
at?
this particular house, I believe, was built in 1992.
That would explain why the law and ordinance disclaimer is so big.
It
All right,
is,
so we're
it
gonna
is.
get to that and talk about
I
that.
love destroying this one in claim. I really do.
So the $16,000, or wait, is it 160? Hold on.
That's 160.
Okay,
yeah.
sorry, my over 40 eyes are not looking at this very well. So $160,000 in personal property, what's that going to cover?
So the general way I like to explain it to all of my clients is I like to give them an example. Let's say you put your house in your hand, right? If you could imagine that, and you take your roof off and you shake the house upside down, anything that falls out
Oh,
is going to be your personal property.
I love it. So anything would fall to the floor is personal
Yeah, so
property.
I mean, you're talking your electronics, your furniture, your
Refrigerator, everything.
Yeah,
Floating flooring.
Yeah. So I imagine the biggest challenge for the homeowner
Mm-hmm.
might be proving what they had in the home and personal property.
That's
you
true.
agree?
I think a lot of times, and that's why you'll see a lot of these coverages are based on a percentage of the dwelling coverage. And the reason they do that is, generally speaking, the larger your house is, probably the more expensive the things
Furniture
are in your
is,
house,
right.
or the more things that you'll have. There's very few total losses out there. So generally speaking, they could go in and see kind of the quality of the things that are in your house and,
Right.
make an assumption from there.
So if you had, I don't know, a hurricane come through and it blew off your roof and it damaged some stuff and you had to replace some of your drywall but not your whole house. That's,
Right. Now, when the hurricane, I'll tell you my story. So when Hurricane Irma was coming through 2 years ago, right? I lived in a frame apartment complex. I was pretty close to the water. I was pretty nervous about all of our stuff still being there when we got back. So I went around and I took pictures of everything and put them up in the cloud. So that way, if something did happen, I'd have proof of what I had.
Any suggestions on that, Leo?
No, I highly recommended it. I took 400 photos the week Irma was coming of every component of my house, closets. I took pictures of model numbers, serial numbers of all electronics. Reason being is after the hurricane came through, the insurance companies gave you the form you need to fill out for personal property. You needed to prove receipts. You needed to prove current photos, current condition. You needed to prove all of these things, or they're just going to deny that piece of the claim.
So how do you prove a current condition of a
You take
piece
a
of
recent
furniture?
photo of
Okay.
it.
Okay. So it has
This
to be
isn't
recent.
every insurance carrier,
Right.
not every claim. It's
After Irma, it was every insurance carrier and every claim.
So we're going to agree to disagree this
We
time,
will agree to
right?
disagree because, like, Adam's on the side of the table where he's going to be writing policies. I'm on the
Right.
side of the table
We're
where
defending them.
either defending or attacking a policy. So I see the outcome of what these numbers mean.
Well, I think it's perfect, really, because this brings a little bit of, exactly where we should be on this topic, right?
Mm-hmm.
So you're talking through what it is and what if, and then Leo sees the flip side to that, which you guys aren't in. By that point, it's the underwriters, right?
the claims
Or
adjusters.
the claims
yeah.
adjusters that are dealing with it. Well, your underwriters.
That
for
actually leads
policy.
me to my biggest question. The software they use to determine your dwelling coverage and the software they use to determine the value of the damage is completely different. So the $400,000 dwelling might only come out to $300,000 in the Xactimate program, estimating the different components of it because they use different indexes.
So where are you going with this?
No, it just baffles me on the post side of the equation, knowing that this dwelling number will never be reached unless it's a total loss. Because if they do the itemization to get there, they'll never get to that dwelling number.
Well, again, it's a limit, right?
Well, you're paying versus that number.
You are, but it's still a limit.
Yeah.
Yeah.
So, I mean, I guess from an insurance perspective or an insured perspective, you have to think about what if it is a total loss. Like, what if your whole house burns to the ground? There's not going to be anything in there.
And then there's the interesting, because back to law and ordinance, is what they determine a total loss versus what an insurance company might. Now, to have a demolition order placed on your home, the damage to your house only has to be 50% or more. The repair cost only has to be 50% or more of the cost of the structure, and then you're at total loss according to city and county.
So once the city and county deems it a loss
Demolition order.
or demolition order,
That's
then
total loss.
insurance has to take it, pretty much, right? Or is this where you come in, Leo?
Adam?
That is a great question for a claims adjuster, Leo.
He's like, I write the policies.
But no, I mean, every case is truly different, and when you do get into the hurricanes and that kind of stuff, I feel like depending on the carrier, depending on the situation, you're getting a lot of outside adjusters. These aren't people that work for the carrier; they're third parties, and they're paid big bucks to go in and try to get rid of the situation as soon as possible, and hopefully.
Well, they have an abundance, right, of
yeah.
people that are dealing with this, as
Yeah.
they did when Irma rolled through.
Yeah.
There's also a huge difference between your deductible versus your hurricane deductible. I imagine we
Absolutely.
should talk about that when we come back after the
Absolutely.
break, you think?
Yes, ma'am.
All right, so a couple of things that we'll talk about when we come back after the break is loss of use. What is that? When can you use it? We actually talked about this on the show before. And some of your personal liability and medical payments. We talked about this yesterday, Adam. And I think that would be an amazing point to run into when we come back after the break. And if you want to get us at our author number and have Adam really explain this to you one-on-one for your personal situation, our author number is 813-377-2775, 813-377-2775. You're listening to Tampa Home Talk. We'll be back right after this break. Welcome back. This is Tampa Home Talk. We're glad you're here. Thank you so much for joining us for our special edition today on the homeowners insurance policy. And before Adam was trying to before Leo was trying to drag all the homeowners carriers under the bus.
I was not. I was just questioning some of the numbers.
So, and again, you have to realize these two see two totally different sides of the equations, right? So Leo's going to be there kind of defend and fight. And I'm sure, Adam, you wouldn't disagree that there's times you have to push the insurance carrier, right, to make it cover something they should.
100%, and that's why we try to do as thorough as we can on the front end to make sure that there are no limitations when it does come to what somebody like Leo could go out and fight for. Because, if you don't put some of these coverages on, it gives him less bullets in the gun if he does need to go out there and use it.
So let's talk about the difference real quick before we might not get into it. The difference between your deductible, like what's the deductible on this policy, and then what's the hurricane deductible, and how does that work?
So you'll have at least two separate deductibles on your homeowner's policy.
Okay.
You'll have a all other perils deductible, which really that means every peril except for hurricanes. And then you'll have a hurricane deductible. So I would say the most common that you'll see out there for the hurricane deductible is going to be 2%. I would say 99% of the policies that I write have a 2%.
So 2% of what?
Of your dwelling coverage.
Okay.
So you're
on
talking
this policy that we bought for $550, we're talking about $400,000.
No, yeah, for a $400,000 dwelling coverage, you're looking at $8,000 out of pocket.
All right, so that's before the insurance company's going to pay anything.
Correct.
So if it's under $8,000, you're on your own.
You most certainly are. And they do that for a couple things. One, obviously, it spreads the risk out a little bit. Two, it kind of helps out when you do have massive amounts of claims. It kind of knocks out some of those smaller ones. Like if your fence is knocked over and your neighbor's roof is entirely off and you both are trying to file a claim, that's time that could really be spent to help your neighbor that doesn't have a roof.
Right, absolutely.
And then your all other perils deductible, that's, like I said, it's going to be everything else. You're talking, fire and water and lightning and everything else like that. Two most common that we see there are either $1,000 or $2,500.
So this deductible is what, $1,000 and $8,000 on hurricane? Okay. Mm-hmm. So let me ask you a question, and I actually saw this happen, but I don't know how it would tie into the homeowner's policy. Mm-hmm. I'm sure you'd have to look at it to figure it out. But lightning actually struck the water meter.
Okay.
In the front of the house, but it's a water leak on the other side, which is for the homeowners, right? Because it's not on the street side. Would that be something homeowners would cover if lightning strikes, the meter or the water pipe under the ground going to the house? Like, how does plumbing tie into this, out of curiosity? Because I really don't know.
So, that is a great question.
Where does it fit in? Do you even know? It's kind of a weird question, isn't it?
It would really depend on the carrier. Now, on this one, they have a service line enhancement coverage.
And is that for that?
It might not be listed. Oh, yeah, top line there. So it gives you a $10,000 limit. And what that is that's for situations like that where the utilities and service lines that are going into your house, something happens to them.
Is that normal on most policies? Would you see that?
I would say it's really carrier dependent.
Okay.
Something that you can add with some of them. Some of them they don't even. It's not even an option.
Okay. So let's run through what these are kind of basically, and then I want to get into the additional coverage section in the language on the back because I'm sure Leo's burned enough to talk about that. But the loss of use. So this covers basically if you're displaced, right?
Yeah. So if you can't live in your home due to a covered claim, this is money for you to go stay in a hotel, your extra food costs, that type of stuff. The reason they include this on here is because, let's say, the hurricane knocks your house down. Unfortunately, the mortgage company is still going to want their money. So this is to help make sure that you don't, not everybody can afford a mortgage in a hotel room at the same time. So that's to help make you, hopefully not go too far into debt on that one.
But now in what cases would you be able to use that versus not be able to use it?
So, we got a lot of calls back when the hurricane happened, and people said, "Well, I got evacuated. I had to go get a hotel room. Do I have coverage for that?" And unfortunately, because there wasn't a claim, there wasn't a covered claim, there wasn't any coverage for it. Because if you get evacuated, there's free shelters and that type of stuff. So you didn't have to go to a hotel room.
Looks at it.
And that's how they look at it. You didn't have to go do it, but you did. So keep that in mind if you are going out. And you're just evacuated and it's not, nothing's really happened yet, that would be.
So this would come into play, for example, if your home was damaged significantly,
Correct.
You can't live in it, and now the shelters they're back to schools or whatever they were before.
Correct.
They were a shelter. So
Correct.
that's when loss of use would kick in?
Correct. Well, and, really once you report the claim and say you can't live there, that pretty much starts the clock.
Okay.
So.
What about personal liability? This is pretty hefty on this one's, what, $500,000?
Yeah, so liability and medical payments is the next coverage down on there. Those two are tied pretty closely together. Liability, that's going to cover, for example, let's say somebody comes over to your house and they trip and they fall and they sue you. That's where that would pretty much come in at. Now, medical payments, I like to refer to it as Band-Aid coverage, right? That's if, let's say, Leo's over at my house and he trips and falls. He doesn't want to sue me, but, he might need some help with his broken arm or something else like that. There's a little coverage in there for that.
But it wouldn't happen if someone broke their arm on a trampoline or something like that, right?
Well, trampolines, that is a question that every single carrier asks before we write the policy. And
there's no exceptions,
there
right?
are no exceptions on that. Liability is excluded for trampolines. So
if you get a trampoline after you answered the question.
You are on your own. Yes, ma'am. Absolutely.
All right, so medical payment to others helps if someone were to break something. Would that include like the movers? What if they trip and fall? They have their own insurance usually,
I would think the movers would have their own insurance.
But if you hired a bunch of guys in a six-pack of beer.
You hire a bunch of guys with a six-pack of beer, hopefully they're not lifting the heavy stuff. So.
Got it. All right. And so policy fee, so what is this? So this is just extra little things?
Yeah, so you're going to see pretty much on every standard homeowner's policy in the state, there is a $25 emergency management preparedness fee, that kind of stuff. So you're going to see
for?
There's two things on here. So one of them goes towards citizens. So that's goes kind of into the state fund.
Pool for insurance. Got it.
So you're always going to see those two on there. And then, so for example, if you're trying to calculate, let's say you have to cancel your policy early because you moved or something like that, you could pretty much pretty much take out the $27, divide by 365, figure out how many days you've been in there, and
that's the only thing they don't prorate.
That's the only thing they don't prorate.
So we talked about the deductibles, which is in here right below it, but what about this law and ordinance of $100,000? Like, what does that cover?
So
what is that for?
So law and ordinance is what that is that's going to be coverage above and beyond your dwelling coverage in case it costs more to rebuild your house due to some new county law, ordinance, anything like that. So the example I like to use there is, let's say you have your house was built in the 60s and it's right down on the Hillsborough River, right? And we all know that if they built that house today, it needs to be 15 feet in the air on stilts. Okay, I can't do a replacement cost estimator for a home on stilts if it's not on stilts yet, but we all know it's going to be twice as much money to put that house 15 feet in the air.
So that's what that other insurance coverage is for.
So that's where that comes in for.
That would be the difference between building the home like this and what's now required.
What's now required, exactly. Exactly. Now, this policy is a little interesting as well because we included increased replacement
Let me
costs.
ask you a question real quick before we
Okay.
get to that, because I'm a back at this. It says forms and endorsement, and there's a whole bunch of insurance jibber jabber that I have no idea what this is, and I'm sure the layperson has no idea what
So
this is.
all
So what
those-
do they do with this?
So all those things right there
Like
equate
it
to all
says
these, right?
HPCH01. Okay, so it
Those
goes
are
to
all the
that.
forms. So if
Okay.
you get that big 60-page policy packet, all of those pages will be labeled with different forms like that, and that'll explain what everything is in there.
Now,
you
what
can
about-
kind of ignore that, but that would be because this is your declarations page that you're looking at right here,
So what about the messages?
and it
Should
go
we-
on top of the.
Should we read the messages, like this stuff in here? Because this talks about replaces all previously issued deck pages, so that means it would replace whatever you got.
Right, whatever the current deck page is, it replaces anyone that came before it.
A rate adjustment of 0% is included, reflecting in building code enforcement grade in your area. Adjustments range from 5 to 46% credit. What does that mean?
So the building code effectiveness grade basically would be how stringent are the building codes in your area.
Okay.
You know, the more stringent, the higher the code grading is.
So an 18% credit for wind mitigation. That means they must have had a roof attached the
They
right
have a
way.
newer roof with some,
Okay.
some clips on there.
And then property coverage limits increased at renewal due an inflation factor of 4%. So this is basically what we
Correct.
talked about in the beginning of the show.
Right. So, right here we're looking at right now it's $400,000. Next year we can assume it'll be at 416 because
Got
they have
it.
the extra 4% on there.
Okay. So the coverage section, is this broken down in all of it? Because I don't remember even seeing anything like this on my own policy.
Yeah, and that's why I picked this particular carrier because they do a great job of breaking down all
not
the
every
coverage.
carrier
Not
does
every
this.
carrier's deck page is as
So how do you
thorough
get
as
this
one.
information if it's not on your policy? Because this is pretty cool. Like, it's got a coverage section, and it just lists out, 15, 20 different
You don't have a
things.
golf cart writer on your policy?
I surely don't think I do.
Well, that's another reason I picked this particular one because, like I said, it really is fully loaded. They have almost every coverage that this particular carrier
Home computer, screen
offers.
enclosure.
So most policies would not look like this.
Most of them wouldn't because some of the things that you're going to see on here, they are built in as certain sublimits. This carrier just does the, they go above and beyond and kind of show you what those sublimits would be.
What's identity fraud expense coverage with regards to a home?
So identity fraud expense coverage would be, let's say your identity got stolen, right? They would pay up to $25,000 for recovery services. They're not tracking your identity, anything else like that. It's just an added benefit if something did
What's
happen.
that got to do with the house?
It's just an
That's
added
what I'm
feature.
wondering. So it's just an add-on, like a rider policy. Okay.
So a lot of the coverages that you're seeing on this one are because this carrier has an endorsement package that fills in all the gaps of things that you'd want to add a la carte, like water backup and personal property replacement cost, and then it increases a lot of the sublimits. So that's why it looks like it has a lot in there, but it's really a package that we added that put a lot of that stuff in there.
So they have some things in here, like they get a senior discount, which is kind of cool. Financial responsibility of credit. So I want to talk about this for a minute because we're the same show that airs the Dave Ramsey show. And as you know, and if you follow Dave's principles, and you literally don't have any debt, your credit score is going to disappear. It won't be zero. You just won't have a score. There's no number in that place. And so Leo, and as much as I love Dave and I'm an ELP, I have to disagree on this just a little bit. And that's because it clearly affects the cost that you're paying for insurance. It's not a ton, but in this case, it's $242 savings, right?
Yeah, and that's like an app. So you got to understand too, if you're looking at that 242, the original before you add in all these credits would be 3,700, and it actually ends up being somewhere in the twos. So
Right.
there's a lot of different things that go in there. A smaller policy, it would be $40, for instance. This is just a larger house with a lot of extra things, so makes it looks larger, but it's just
Yeah.
a percentage.
Well, I mean, it's still like the point is, and your base policy amount might be different, right? If you don't have a score, is that fair?
So all the carriers, what they'll do is you'll start with whatever the
Top of
base
the premium.
premium is, you have that, and then if you say have a great insurance score, which is a combination of credit and past claims history, then that will go into
5
that.
seconds.
All right, this is Tampa Home Talk. We'll be back right after the break. Rock on. I'm your host, Katrina Madewell, hanging here today with Adam Talley and Leo Cannyn. We're talking all about your homeowner's insurance policy, how to dissect it, what to look at, what questions you should be asking your insurance carrier before it's too late or you might have a claim, or if a storm rolls through. In this particular carrier's Heritage, and they did a good job breaking down essentially the coverage section and what's the extra stuff and what's not in there. So this part's pretty cool because you can clearly see a lot of what you have and what you don't, at least enough to ask more questions.
Well, yeah, I'd like to ask a question about the screen enclosure carport coverage, because that's like an area where storms coming through, hail damage, that's the first place they look, was the screen damage. So
correct.
Because
And
it's floating out there and it's like, damage me, I'm weak.
yeah, so and when it comes to the screen enclosure coverage, what you'll find is pretty much for all of your perils, like fire and lightning and that kind of stuff, it would be built into your dwelling coverage. But when it comes to your hurricane type of situation, you'd have to add it as an additional endorsement here. So that's why you see this person has a $10,000 limit.
So are you telling me most insurance carriers, and I have to ask this question because I had, one of those other big insurance carriers for years that decided they weren't going to write in the state anymore. And when one of those storms rolled through, I think it was around 2004, I literally had a perfect circle, more than one, in the top of my screen lanai coming into where the pool was. Perfect circles. Definitely hail, without a doubt. There's no way it could be anything other than hail. Of course, Citizens was not going to cover that because they don't cover anything. But I don't even know if my carrier now would cover it. And even so, I think my deductible probably would be too high to do anything about it.
And that's the other thing that kind of gets at it too is, if it's during a hurricane, you have an $8,000 deductible and that's the only thing that's damaged, well, you might be on your own anyways. And when it comes to the screen enclosure coverage, depending on your carrier, it's truly only covering that aluminum frame itself. It's not covering the screen material. So if your screen, broke during the hurricane, there probably wouldn't be any coverage for it.
They're pretty inexpensive enough to get it done, but it's just if you have
I've
a
never
lot
seen
of
a screen
things.
covered.
Yeah.
So the screen part they don't cover.
Yeah.
It's just that if there's so many things you have to cover, that's where it's going to matter.
Yeah, if you're talking everything's destroyed, then that's why you'd want it on there, because now they're not going to, not cover it basically.
So why
at
is
that
there a
point.
little note on here for increased replacement cost dwelling? What is that about?
So increased replacement cost or dwelling, what that is it's usually a percentage, so sometimes it'll be 10% or 20. And that is, again, it's money above that dwelling coverage, but it's for instances where it costs more to build the house, but this not necessarily due to a new law or something. It could even be there's a hurricane out there and now everybody on the block has to have their house rebuilt. So instead, if you're just talking about a one-off house, maybe it only costs $400,000 to rebuild. But when all of the building materials are more expensive, labor's more expensive, that type of stuff, that's built in there to make sure, okay, I will have enough money to go, and have this thing rebuilt regardless of the situation.
The neat part about this policy that we're looking at is there's a lot of things kind of just included. They just include it. It looks like it's a part of their standard policy. And some of this is like water backup and sump overflow, personal property, identity fraud expense.
Yeah, so water backup is one of those things that I always recommend you add onto your policy a la carte. It's usually about $25 to have it added on. The reason this one's included is because it was part of that package, right? So I always include that package because it's less expensive to have the package than it is to add replacement cost and water backup, a la carte, which I would do anyways because I find those two to be very important.
You know what we should do, Adam, and I think maybe we'll table this for another day, but you should have a list of questions that a homeowner's insured, potential insured should be asking their insurance carrier so that they know how to properly package that insurance and which carrier to put them with. Don't you think that would make sense?
Yeah.
And Leo, you see a lot of stuff of that on the flip side, right? So if you guys want to run into this big, special, bold, underline, italic, huge font, I would say 4 times the size of everything else, which, by the way, in any contract you ever look at, if it's ever bold, underline, italic, the font's bigger than everything else, it's probably something you should read.
It is very important. And the things on the back here are things we already talked about, but it's sometimes people, they need to hear it multiple times to really get it through because...
But again, if you don't read anything...
If you don't read anything...
something underlined, bold, larger font, read that.
Yeah, because they're going to, if you go to them and say, I didn't know that I had a higher deductible for hurricane, they're going to turn this around and say, well, it's right here, it's right here, you initialed on
Right.
the application,
So
it's all there.
One of the things we probably should mention as well, because we've seen this a lot over the years, your homeowner's insurance does not cover flood. It does not cover any type of rising water whatsoever.
Correct.
People
However,
confuse that.
nowadays we have a handful of carriers that are doing a flood endorsement.
So an additional rider.
So
add-on.
it'll be it'd be an added cost depending on where you live.
What does
It's-
that look like in terms of the cost and the coverage, roughly, if it's a rider?
It's usually fairly comparable to the price that it'd be if you went through the NFIP, which is the National Flood Insurance Program.
So why wouldn't you just do that?
Because with this, you get to choose what amounts you want. So if you're in an X flood zone, right, which is a
not a flood zone.
non-mandatory flood
Right.
zone, then the max you can get is $250,000 for your dwelling, and it's basically it's slotted coverages. So if you're at 250, you get 100,000 for your contents, but it's ACV anyways, and that's what you get. With these policies, if you can add flood as an endorsement, usually you get to choose what you would want for your contents coverage, and you can add replacement cost for your contents as well, which kind of changes things up quite a bit in the event that something did happen.
Right. So, Leo, you see the flip side of this, again, a lot of times, not to throw Adam under the bus, but you just see the other side after the policy is written and you're trying to defend it. So what questions should people be asking Adam before they ever have to deal with you?
I mean, the biggest thing I've always seen on any of these policies is that dwelling number. It's like, question how they're coming up with it. There's 3 different acceptable methods to determine your dwelling. Maybe one of them works better than others. A special appraisal.
Those methods were what, again? To the 2 that you guys use, right?
The Marshall and Swift.
is the
Marshall,
other
Swift,
one?
and Beck is one of them. 360 is the other.
And those are insurance.
Those
driven.
are
And then what's
specific
the third?
insurance tech, and then
Yeah, it's an appraisal.
Yeah.
An action, not an FHA or a VA. It's an insurance appraisal.
So it has to be an additional appraisal.
Yeah, additional appraisal, but that appraisal is going to get you the most accurate information. Because like even here, I mean, this Heritage is a good company. Here they're saying they're automatically going up 4% by a national index of construction costs. Florida's got their own construction costs, so 4% by national index is not accurate for Florida. So that's one area where they're just going to up your policy.
Yeah. Now, one thing that we will do is if it's been a few years, most of the carriers, we can rerun a current replacement cost estimator and send it into them and say, hey, we need to either decrease this, or this guy did a bunch of renovations, so we actually raised it about $50,000.
Got it. Well, there's so much that we have packed into the show, and I think easily we could probably talk about it for another hour. Since Danielle Evans will be in next week, you guys will have a chance to talk about that insurance appraisal, and I'll be out, so you two will be running the show. Remember, love where you live, or I'm going to fix it, and our off-air number is 813-377-2775, 813-377-2775. Welcome home. Have a great weekend.
Awesome.